then now the rebound that we've seen since the middle of last year. Rebound which basically has been stronger and quicker than expected. Initially, most analysts thought that we would, at least like you see there in 2008, 2009, at least it would take some 10 quarters to get back to the level of before the pandemic, but it seems to be to go very much more quicker than that. Why? Basically, we all know obviously the stimulus that has been put in place to fight against the recession has been enormous. This is a study done by McKinsey, which basically just compared what has been put in place in terms of stimulus last year compared to what had been put in place when we had the financial crisis in 2008. You see, it's always in relation to the GDP of the different countries. So you see, for example, Germany last year, basically the stimulus put in place was equivalent to nearly 1/3 of the German economy, whereas 12 years ago it was only 3.5%. So obviously huge stimulus, which meant that obviously the rebound and the economy was able to recover quite quickly, especially once countries started to reopen. The next slide is interesting in the sense that it's completely unusual in a recession. This is what the slide shows is the disposable income of the US households, and it's more or less the same when you look at the Eurozone, for example. And normally what happens obviously in a recession is that the disposable income falls because people work less or lose their jobs. So normally disposable income falls, and that is basically what would have happened if you see the red line. But what happened in reality is that disposable income, at least in the US, even increased. Why? Because often people got a check from the government and the amount on that check was higher than what they earned in their job. So basically, and that's completely unusual in a recession. This time we had a recession where the disposable income of the households increased. And that obviously allowed for these households to either continue to spend on durable goods. We often heard the stories last year of people improving their garden or their house or these kind of things. And once the economies reopened, obviously there was some kind of money there to spend again on services, whether it's restaurants or traveling, etc. This graphic, I don't know, on my slide, it seems a little bit strange, but basically the idea is simply to say that obviously this had a cost, all these checks and all this aid from the government obviously meant that the government, that budget deficits in most of the countries have increased a lot, and in the US the budget deficit has been above 12% of GDP. So again, numbers that we've never seen in the past. And it's incidentally this idea which leads a lot of people to be quite optimistic on the growth outlook. So what this graph shows, it seems a little bit complex, but it's actually not very complex. The vertical axis is the monetary policy and the horizontal axis is the fiscal policy, and it's for the euro area. And so once we, in the high, so above these two, we have a tight monetary policy, and below we have a loose monetary policy. On the left we have a loose fiscal policy, and on the right a tight fiscal policy. And what we've seen basically after the financial crisis is, and we all know that monetary policy has become more and more expansive with 0% interest rates, with quantitative easing, etc. But the fiscal policy, apart from this year's 2010, 11, 12, which was marked by the Greek crisis, etc., in the Eurozone, but otherwise the fiscal policy was still kind of restrictive in the sense that the Maastricht criteria of -3% was still respected. And obviously what happened last year is that we moved to the lower left side in the sense that last year we saw, and we still seeing this year, loose fiscal policy plus loose monetary policy. And a lot of people think that this is basically what the crisis has engendered, the pandemic, in the sense that we'll now abandon this fiscal rigor, this fiscal, and we'll go more and more in this direction of government spending aided by very low interest rates. And some people take that as a reason to become more optimistic on the growth outlook by saying that we'll have huge government spending and that will boost economic growth. Problem for us with this is that we still think that for an economy to work and really to have a structural acceleration in growth, you need the private sector and not the public sector, in the sense that if it was that simple, if it were enough for governments to start spending a lot to gender healthy growth, and then obviously we would already know that. So in the center, for us, basically what the environments that we've seen basically over the last 20 years, and especially since the financial crisis, of GDP growth getting lower and lower, or at least settling around levels which are much lower than in the past, is still very much valid. So we still think that after this period of now stronger growth will again become weaker going forward. And we've often spoken about the reasons behind that, let's say, that's weaker growth. And I think most of these reasons are still pretty much there. First reason, obviously, is the high debt levels. There is unfortunately quite a strong correlation between high debt and low growth. And what we've seen last year, obviously, is that the debt has increased even more. In this case, especially the public debt. And we now have debt levels which are historically high. And again, that doesn't point necessarily to stronger lasting growth. Second point is demographics, in the sense that for growth, you need people working, and you need productivity of these people increasing, and people working, that's and the working population. And we see now that because of demographic trends going forward, the working population, often defined as people being between 20 and 59 years old. You can see that's a little bit arbitrary, but you see that because of the demographic trends that we see in the industrialized world, but more and more also in the so-called emerging world, the population, this working age population, is declining. And when it comes to the productivity of people working, often there's a link, and it's logical, a link between productivity and investments. And investments over the last year have been quite weak. You see that here for the US, you see that profits in terms of GDP have increased a lot, but companies didn't necessarily use these higher profits to invest a lot. The investment was quite moderate, which was incidentally very good for shareholders, because the difference could be paid out to shareholders in terms of share buybacks or increased dividends. But generally speaking, for the economy as a whole, it's not necessarily a very good sign. And the next point, and I think it's a very important point, because when you look at the world economy, we still have to oversimplify a little bit. We have a world economy which is very dependent on the US economy, and we have a US economy which is very dependent on the consumer. So US consumption is more or less 70% of US GDP. And you see here that the situation of the consumer is not that good. Here you see that personal income nowadays, nearly 35% of this household income comes from the government. So it's not coming from people working and getting paid for. It's a big part, at least, of their income is coming directly from the government. And that's obviously not a very healthy situation. And it's very different from what used to be the case in the US. So nowadays you have an economy there where the household income, again, comes to a very large degree from the government. So not a very stable or healthy situation. And then you see this trend, which again last year was very, very present. Here you see basically consumer spending, it's a red line in terms of GDP. And as I said before, consumer spending is nearly 70% of GDP. And blue is labor income. So basically the two should move in line. If people earn more, they can spend more. But you see that this hasn't been the case. And especially last year, you see again a big decline between the two. Again, this labor income, which you see declining there, was the decline in that labor income was partially or was compensated by government checks. But again, it's not a very stable and healthy situation. And this basically leads us to this idea that, yes, we have a rebound in growth. Yes, currently we have stronger growth than what we have been used to over the last years. But again, for us, it's more a short-term acceleration in growth. It doesn't mean that going forward we'll get much stronger growth. And when you look at the more day-to-day numbers. This is the Citigroup Economic Surprise Index, so it usually looks at every economic number that is being published, and then it concludes is the number above or below expectations. If it's below, it's a negative. If it's above, it's a positive. This is for the biggest 10 economies, and you see that recently most of the economic numbers were disappointing. Basically, what we've seen recently is that when it comes to growth, all the economic numbers were disappointing. And that's the next slide, and that's the transition to inflation. When we look at inflation, all the numbers were higher than expected. So inflation, and I think inflation is maybe even more so than growth, is what's right now what's the main question mark for the financial markets. So here you see the inflation rates in the OECD countries, and you see obviously the pickup in growth that we've seen recently. In the US now, inflation is above 5%, and central banks are still telling us this is only temporary, and then inflation should decline again, and so there's no need for them to intervene. That's still basically their conviction, or at least that's what they're telling us. But the reality is, I think, to a certain degree, that when you look at the elements that historically and typically influence inflation, what obviously there's still some disinflationary elements, the most important of which is the technology. But a lot of the other factors that used to be disinflationary, like globalization, etc., are now moving much more into an inflationary direction. And so that's something that one has to be aware of. I think when you look at these different factors, and at least I think the conclusion is that the medium-term risk of inflation, of much higher inflation, has increased. But again, something which was very unusual in this recession, I said before, what was very unusual was that disposable incomes increased in the US, whereas normally in a recession they fall. What was also very unusual is the following slide, and it's basically what I've tried to show on this slide is the typical demand and supply curve. So when you look at the typical recession, so the above slide, you see that normally the demand curve goes from above left to below right, because vertical axis is prices, horizontal axis is quantities. If you have high prices, people don't buy a lot, so quantities are small, and if you have low prices, people buy a lot, so quantity is high. So that's the direction of the demand curve, and the supply curve obviously is the inverse. And normally in a recession, demand suffers because people earn less, but supply doesn't change a lot. So that means that normally the recession leads to lower prices and is more disinflationary than inflationary. But in this recession, things were different in the sense that the supply curve has moved. We all know that there's a lot of areas now where the supply is lacking. And that's obviously means that the situation this time is very much different. So it's more a question of which one moves more, the demand or the supply curve. And again, the demand curve hasn't really suffered that much. At least demand has rebounded quite quickly, but the supply has diminished. And supply, by supply, I mean supply of most of goods, of commodities, and especially of labor, and that's again that's a different kind of inflation. So it's less an inflation which is based on excess demand. It's more an inflation based on lack of supply, which also means that for the central banks it's difficult to react because they can raise their interest rates, but that doesn't necessarily lead to supply reappearing. So maybe the last point on inflation is that to have lasting inflation, you need wage growth, because if you have inflation without wage growth, it can't be lasting, in the sense that, for example, if you have higher oil prices and people don't earn more, then they have to spend more to heat their house or to fill their car, but they have less money to spend on other things, and then the prices of these other things will fall. So then you have a situation where prices of some items will increase, but that will be compensated by the fall of the prices of other items, and the general level of price level doesn't necessarily increase. So to have lasting inflation, you need also inflation followed by wage growth, and then to have some kind of a domino effect. And that's basically what we had in the 70s, but then wages were indexed in most countries, and nowadays that's no longer the case for most countries. But we see now that wage growth still has increased, and we often hear these stories about a lot of areas where companies now have problems finding workers, and so that has led to some kind of wage growth. And historically, basically, there was a tight correlation between the Fed funds rate and wage growth. So normally when wage growth increased, and the Fed tended to tighten its monetary policy, and when wage growth fell, then the Fed tended to loosen its monetary policy. And when you look based on this correlation, obviously the Fed is behind the curve. But on the other hand, it's logical compared to what central banks are telling us. They told us they would like the labor market to continue to improve. They told us they wanted to have higher wage growth to reduce the inequalities. They told us that they were willing to accept higher inflation for a certain time before tightening their monetary policies. So you could say that to a certain degree this is logical, but again, it's an important slide because it might lead to the Fed raising its interest rates sooner than expected. Right now, the market is still expecting no Fed rate hike before the end of next year, but that might be a reason why the Fed might act sooner than expected, and obviously that would not be a very good news for the financial markets. Maybe to conclude on the macroeconomic environment, it's always interesting to look at what the bond market is telling us. When you have been working in this area for a long time, you've learned to respect the signals that the bond market is sending. Sometimes bond yields increase, and you don't necessarily immediately understand why are bond yields increasing. There's no need for them to increase, and then obviously exposed this increase in bond yield was very logical. And here, what you see the bond market starting middle of last year was saying, okay, I think that economy will improve because bond yields were rising, but then suddenly at the end of the first quarter of this year, they stopped rising and they fell again. Now they've increased a little bit again, but generally speaking, the bond market still seems to tell us that they expect, or it expects the growth to remain quite moderate and inflation to fall back. That seems to be the message of the bond market, because otherwise this doesn't make any sense. Right now you have, when you look at the economic conditions, you had nearly 7% real GDP growth in the US in the second quarter, inflation rate of over 5%. That's still the case for September. Incidentally, you have commodity prices having gone up a lot. And on the other hand, you have a 10-year bond yield, which nowadays is around 1.4, 1.5, the Fed funds rate at 0, and still no tapering. So one of the two doesn't make any sense. So the bond market seems to say, at least when you look at it from here, seems to say that the left part will not last, and economic growth will again get weaker, inflation will get weaker. But the big question mark nowadays is, can you still look at the signals sent by the bond market? Are these signals still valid? The reason I'm saying this is that normally when you look at the yield curve, this is horizontal axis is the maturities, and the vertical axis is the yields. And normally, obviously, on the horizontal axis, the left part is directly fixed by the Federal Reserve. If they say that they put their Fed funds rate at 0%, that's where it is. The market can't change that. But normally, the longer maturities, 10-year, let's say, is influenced by the market, by normally rational investors. And if these investors were to think, okay, I think that inflation will go up, they would sell these bonds and then driving up yields. But the big question mark nowadays is this still the case? Because even the long maturities nowadays are more and more influenced by what the central banks are doing. Here you see, for example, that in Japan, the central banks is nowadays holding 50% of government bonds. And that's up from 5% some 10 or 15 years ago. So, and obviously, if such a player, and that this is obviously a player for whom the the yield has no importance at all. They're buying for other reasons than the yield, so it's not a rational investor in that sense. And if you have such a massive buyer of government bonds independently of the price, then you could say then the signal of the bond market is completely distorted. And in the Eurozone, it's a little bit the same. As the European Central Bank is holding more or less 40% of government bonds and have increased most of the of what has been coming out over the last months. So from that point of view, again, you have a major player who doesn't care about the price, doesn't care about the yield, and is simply buying. And that means that for me, at least, I think that the signals coming from the bond market, you have to take them with a grain of salt, because it's no longer that valid. So basically, I think here I've tried to summarize a little bit a few, I think, ideas which for me seem important. And it's a question: are we in a change of regime? And I've tried to here for different blocks. You have the macroeconomic context. Before it was marked by moderate demand, elastic supply. Now it seems to be marked by moderate demand but less elastic supply. That's obviously something which is very new, because we were used to thinking that if we need supply, the supply will be there. Fiscal policy, before it was already marked by rising public debt, but there was still some kind of constraints upon excessive budgetary deficits. Now we already have very high public debt and the progressive abandonment of budgetary discipline. Monetary policy, we have, since the financial crisis, we basically have hyperactive central banks, but we had low inflation. And so with this low inflation, their hyperactivity was not too much put into question. And basically people are saying maybe interest rates are too low, but since there's no inflation, it's not that important. And so this low inflation was also allowing relatively low risk premiums on bonds. And the interest rate risk was primarily cyclical. So from time to time, interest rates went up, but that was only temporary, and then they fell back again. Again, now we have this fiscal monetary complicity. So expansive, loose fiscal policies financed by loose monetary policies. Hand in hand with that, you get these rising doubts about central banks' independence. The interest rate risk is becoming more structural, because if we were really to move into a much higher inflation environment, then still there would be a risk of interest rates rising structurally, and then you'll get higher risk premiums on bonds. And for the equity markets, again, there's a lot of things seem to be changing. We had a very favorable environment over the last decades for stock markets because of the deregulation, globalization, declining corporate taxes. You had inflation basically in the 0 to 2% range, which historically has always supported high equity valuations. And you had a shrinking labor share of output. So it was more capital, company profits, which were the big beneficiaries. Now we're moving into much more regulation, onshoring again of supply chains, so higher corporate taxes, maybe higher inflation, which again historically has led to a price earning compression, and the rising labor share of output, which normally means lower company profit margins. So again, one has to be aware of these trends, one has to be aware of these risks, because again, we seem to be at a crossroad where some things might change, and one of the biggest question marks and things which will determine in which direction we are going is this question about inflation. If it's only temporary, then maybe a lot of the risks for the markets are much lower. But if we move into a much more lasting inflationary environment, then things will change. So the global flexible, again, what does the, maybe I'll start with what the fund tries to achieve. As I'm often saying, I try to have some kind of a all-road portfolio, in the sense that a portfolio which during risk-on periods where the risk appetite is high and where there's money to be made, then during these risk-on periods, obviously the portfolio tries to produce a decent performance. But during the risk-off periods, when people are afraid, when the risk appetite falls, and when usually financial markets are not behaving, or at least equity markets are not behaving that well, then the company should at least not lose, the portfolio should not lose, too much. So the idea is to have a portfolio which during good times generates a decent performance, but during bad times will at least protect to a certain degree the value of the portfolio. And you see this here basically when you look at the asset classes. You have equities, S&P represented by the S&P 500 index, and the table basically shows during the last 30 or 35 years the periods where the S&P 500 has suffered on average by 22%. And during these periods, normally you had assets like US Treasuries or gold who have at least protected the portfolio to a certain degree. It didn't offset completely the fall in equity prices, but at least they were able to protect the portfolio in a certain to a certain degree. And that's basically also what I try to achieve with the portfolio. I use equities, I use long-term government bonds, I use gold, and obviously I have cash. And it's the combination of these four asset classes which through this combination of these asset classes, I try to establish a portfolio which should have an interesting risk-return profile and which should avoid too high drawdowns. The other point I'm always making these days is that often people simply look at the portfolios, they look at the equity portion of the portfolio, and then if the equity portion or equity weighting is around, let's say 70%, like it's right now in my fund, they conclude that the fund might be risky compared to a fund which might only have 30% equities. And the reason of this is that we all used to defining risk as volatility. We all know that equity prices move much more than bond prices. And so equities with this definition of risk are considered high risk, and bonds and cash are considered low risk. And I think that this idea makes less and less sense, and that first of all, that the risk nowadays is not necessarily volatility. The risk is a loss of your capital, or at least of your purchasing power. And obviously, this risk becomes more and more important in times of higher inflation. And in that environment, I think that it doesn't make any sense to look at equities or bonds as a homogeneous asset class and saying equities are risky, bonds are not risky, but you have to basically differentiate more between risk on and risk off. Like for every good football team, you have to find a good combination, a good mix between offense and defense. And here it's the same. So you have obviously equities which are more risk on, high beta equities, more cyclical equities, smaller caps, but you also have equities which you could consider much more risk off, much more defensive, low beta, etc. Bonds the same. You could have emerging market bonds or corporate bonds which are clearly more risky, and you have sometimes government bonds which are much less risky. And currencies also in that respect play a certain role in the fund. You have currencies which are much more risk on, like for example commodity currencies. You have currencies which are much more risk off, like for example the Swiss franc and the yen, which tend to appreciate during times when equity markets fall. So from that point of view, again, for example, the Swiss franc and the yen together are quite important in my fund. Say together they represent something like 25%. And again, for me, it makes sense in this idea of constructing a portfolio which tries to establish a good mix between what I just said, between offense and defense. When it comes to equities, people who are familiar with our funds, whether it's the equity funds or the equity portion of the mixed funds, already know that we have a certain philosophy, we have a certain methodology, and this methodology is basically to say we only want to invest in quality companies because we see the purchase of a share as a long-term participation in a company. So we only want to have quality companies, and we only want to buy these companies at a valuation which is reasonable. So there's these two big aspects, quality and valuation, Quality, what does it mean for us? Quality company, it means a company which has something which allows it to differentiate itself from its competitors. And by being able to differentiate itself from its competitors, we often obviously call that a competitive advantage. These companies are able to generate higher margins, higher profitability, more free cash flow. By generating more free cash flows, they can finance themselves, so they don't need to take on debt, so they have stronger balance sheets, and generally speaking, they are in a virtuous circle. And then valuation obviously is also very important. We have, for all of our companies, we do our own valuations. But these two aspects, quality and valuation, leads us to have very strong structural biases in our funds. So typically, what you don't find in our funds, and it's in our equity portfolios, and this is true for Europe as well as for the US and Asia. It's true for small caps or large caps. Normally, the sectors that you see on your right, you won't find them in our funds. So basically, we don't invest in these sectors like utilities, telecommunications, car producers, commodities, airlines, because for us, these are sectors where it's very, very difficult for a company to have a lasting competitive advantage. These are usually price takers, they're not price makers, and so there's a lot of competition. It's difficult to differentiate yourself from the competition. So we said, let's not waste our time by looking at finding the rare exception in these sectors. We won't invest in these sectors. Banks, insurance, it's also says the fact that we are not able to value the companies in this area. So again, if we can't value a company or a sector, then we prefer not to invest in that sector. So everything on your right, you typically don't find in our equity portfolios, and obviously in the equity portfolio of the Global Flexible. On the left, you see then what you typically find in our portfolio. So it's consumer staples, the Nestle's of this world, consumer cyclicals like the LVMHs, industrials, healthcare, and technology. That's typically where most of our funds are invested. And it's very important, obviously, to know, because especially when from time to time you have this talk in the markets about value making a comeback, usually what the market nowadays associates with value are the sectors on your right. And again, we won't invest in these sectors. So how is the fund currently structured? As I said, equities, it's a flexible fund, but given the current market conditions, one should expect the equity portfolio to remain quite high, so not between 0 and 100%, but I think right now I don't necessarily see myself going below 40%. So there's still some kind of an equity bias, unless the situation were to dramatically deteriorate. And at the end of September, I had some 70% invested in equities, as I said, on quality companies with lasting competitive advantages. Fixed income, given right now the fixed income part is only there for this, what I said before, for this idea of risk off. So it's not necessarily there to make a lot of money. It's there to stabilize the portfolio, to help the portfolio in times where equity markets suffer. So, and given that interest rates are very low, I tend not to have too high a weighting in fixed income. So even though, again, the allocation is completely flexible, right now you can expect somewhere bonds making up somewhere between 5 and 15% of the portfolio. So quite a low weighting, but compensated by the fact to a certain degree that I only buy very long duration bonds. So it's only government bonds, it's only US government bonds, and it's essentially 30-year US government bonds. So why this long duration? Again, it's this idea that when equity markets suffer, bond yields usually tend to decline. But to benefit from this decline in bond yields, you need obviously long duration. If you have only 2-year bonds, then the decline in bond yields won't increase the price of your bonds very much. And so your fixed income part will not compensate for a lot of the fall in equity prices. But then when you have 30-year US treasuries, then obviously it's a different situation. And that's why I tend to only buy very long duration bonds. right now you see there that the portfolio is only in the lower part of this range, 5 to 15%. I'm currently around 6%. Why? Because last year when the 30-year US government bond yield fell below 1%, I completely sold my bonds. So I didn't have any bonds anymore. Now, since bond yields have increased over the last few months, since the middle of last year, I've bought back a few bonds, but I'm still quite low in my allocation. If bond yields were to continue increasing, then I would increase my weighting. But right now, they're still too low for me to really be willing to increase that allocation a lot. And then the third category is precious metals. Again, you see that my target is not very aggressive, between 5 and 15%. Why? Because obviously gold price is volatile. But again, I'm looking for this kind of leverage. I want this relatively low weighting still to be able to make a difference during the times where I need it. And here I get this leverage by not buying paper gold, but by buying gold companies, which obviously amplifies the movements of the gold price. So I buy gold companies and not gold paper gold. You could say, but if you buy gold companies, these are equities, and then you should add the 13.3% to the 70.4% and tell us that you have 84% equities. But for me, that doesn't make any sense, because to a certain degree, the gold equities are there to protect the portfolio against the equity risk coming from the other 70%. So it doesn't make any sense to add them together. Say one is supposed in the medium term to be some kind of hedge against the other. So from that point of view, I always, when I present the fund, I'm always making the difference between the two. Coming back to the equities, because that's the biggest weighting, obviously, you could say within my equity portfolio, you could distinguish my holdings and put them into three different categories. The first category is what people always call the secular growth story. So companies where the growth outlook is quite strong because they're benefiting from structural trends. The sometimes technology companies or things like LVMH. These are basically and have been the main beneficiaries of a low interest rate environment, because they were offering good visibility on growth, and obviously with low interest rates, their future earnings are discounted at a lower interest rate and make up more in their current value. So from that point of view, they were the main beneficiaries, but because they were the main beneficiaries, nowadays their valuations tend also to be quite high. So over the last months, I have tended to reduce this part of the equity portfolio. And then you have the other two categories, which I have tended to increase over the last months. One category is what I call quality companies, because we only invest in quality companies, but these are companies that have tended to underperform, or that have underperformed the stock market quite a bit over the last 2 years. So basically, in a little bit arbitrary, the stock, the MSCI World over the last 2 years has done something like 70%. So I've chosen here companies which have done less than half of that, because maybe the company had some short-term problems, or maybe the company was out of favor with investors. And given this underperformance, they now offer quite attractive valuations. And the last category is what the so-called bond proxies. These are basically companies where I think they can replace some of the traditional bonds in your portfolio, because they have a attractive dividend yield, a stable dividend, a growing dividend. They're more defensive, low beta. So this is another category that I like quite a bit. And again, over the last months, even though the overall equity allocation has not changed that much, but within this equity allocation, you could say to a certain degree, I have switched from attack to defense, from risk on to more a prudent, more risk-off approach. Sector allocation of the fund at the end of September, you see here on the black is the MSCI World Index, beige is the fund, and you see what I said before, no financials, no utilities, etc., etc. So basically, this is this idea what I said before, that there are things that we don't invest in. Region allocation, again, this sometimes, I don't know if you see it, but sometimes on the iPad I don't see anything here, but region allocation, I think the important point to make is that compared to an MSCI World Index, where the US market is making up more than half of the index, I have a lower weighting in the US and I have a much higher weighting in Asia. So Asia makes up some 25% of the portfolio. Around 10 or 11% of that is Japan, and the rest of it is Asia ex-Japan. And when I said before that I've tended to increase the second category quality companies that have underperformed, then obviously that has also led me to move more towards Asia, because Asia has underperformed, especially the US over the last year, and then there are more attractive opportunities to find there rather than in the US. The other point about the US to make is that I said before, we have some strong sector biases. I said that we typically invest in consumer staples, consumer discretionary, industrials, technology, and healthcare. And the technology aspect is very important for the US. When we're very bullish on technologies, and given that technology to a certain degree, to a large degree, is the US, then the weighting of the US increases. But when you're more prudent on technology, like nowadays, then the weighting of the US tends to increase, because in the other sectors, consumption or healthcare or industrials, we often find better and more interesting companies outside the US. So technology, to a certain degree, determines also the weighting of the US. I said before, just maybe 3 slides on Japan, because sometimes people are wondering why I have nearly the same allocation in Japan than in the US. First of all, Japan has underperformed massively over the last years because it has underperformed so much. And this underperformance, until at least recently over the last years, has nothing to do with lower earnings growth. Quite the contrary, earnings growth in Japan has been more or less the same than in the US. Despite that, Japan has underperformed, which means that valuations in Japan are attractive. These are price book, price earning, cyclically adjusted price earnings, Japan relative to the world. So Japan is valued quite attractively. And the big problem of Japan that we seen before was usually that the profitability of Japanese companies was not very high, whereas shareholder value has been taken to one extreme in the US. Japan was a little bit the other extreme, and that has been changing. So the profitability, the margins of Japanese companies have structurally increased. So nowadays, not that much lower than in the rest of the world. And I think this trend will continue. So from that point of view, I think that Japan remains a very interesting market, and we find a lot of high quality companies in Japan, which are often world leaders in their respective sectors. But Japan sometimes is I don't know, the foreigners sometimes don't like Japan. Often it's for top-down reasons, deflation or debt or demographics. But the bottom-up story in Japan is actually very interesting. And the other Asian markets also are very attractive. I've here simply shown one graph to illustrate this. It's a difference in the dividend yield between the emerging market countries and the industrialized markets. So right now the difference in dividend yield is historically high, which you could say means that emerging markets are now very attractively valued compared to the industrialized markets, and especially the US. This is just an example of a bond proxy. What I meant by bond proxy is, again, it's this type of equities, defensive equities, which in a time where the yield offered by government bonds, at least in the Eurozone, doesn't make any sense at all, then maybe you might be better off with these companies, knowing very well that these are equities, so they're more volatile. But again, I think it makes a lot of sense when you look here, for example, Nestle compared to the French government bonds. Nestle, you start with a dividend yield of 2.4%. The coupon on the OAT is 0.15. The dividend of Nestle is increasing. Coupon is not increasing, etc., etc. So this is a little bit this idea of defensive low beta companies, which I think in a balanced portfolio now can replace the part or can replace government bonds, at least when you look at recurrent income. And incidentally, Nestle last week had very good earnings. It's again this idea of pricing power, companies being able to pass on a rise in their costs to their consumers. And again, that's obviously the kind of companies that we want to have in our portfolio, price makers and not price takers. Fixed income, as I said before, I won't again go into detail about this, but again, it's government bonds, it's 30-year US Treasuries, it's the fixed income part right now in the portfolio is there to protect the portfolio during risk-off periods. And for a long time, my fair value for the 30-year bond yield in the US was 3%. So each time when bond yields went above 3%, I tended to increase my weighting going towards this 15%. And when bond yields fell below 3%, I decreased my weighting going towards the 5%. But then 2 years ago, the situation changed, and especially obviously last year, bond yields dropped below the lower part of that range, and since then have maybe established a new range. And again, on this slide, you see that they dropped towards 1%. They were, even for 1 day, they were below 1%. So I completely sold all my bonds. And since bond yields have increased a little bit since then, I've again come back a little bit into government bonds. But again, at around 2%, I would prefer the bond yields to be higher. I will typically act in a contrarian way. So if bond yields rise, bond prices fall, I buy. If bond yields fall, bond prices rise, and I sell. And again, that's what I intend to do going forward. I don't necessarily expect in the short run to see bond yields reaching again this 3%. So maybe we'll have to establish a lower range. But so the 2% right now, for me, is still too low for me to be comfortable to increase my bond holdings. And for gold, as I said before, gold to a certain degree is the ultimate safe haven, and the idea is it's to protect the portfolio during difficult times for equity markets. I don't buy gold, but I buy gold companies. First of all, the rationale for the gold price correlation usually is very high between gold and interest rates adjusted for inflation, so-called real interest rates. Here you see that on this graph. Red is the gold price. It's the left-hand scale. Blue is the real yield right-hand scale, but inverted. So if the blue line rises, it means that real interest rates are becoming more negative, and obviously that's good for gold because it doesn't produce any cash flow. So that's what we've historically seen, and since I don't necessarily expect real interest rates to go up, I think that we're still in an environment which is quite good for gold. Why gold companies? Gold companies have, first of all, they offer this leverage that I'm looking for, but they also have underperformed the gold price quite a lot. Here you see the gold price over the last 10 years. In 2011, you had gold establishing what was then a new all-time high around $1,900 per ounce. Then it fell, and it has only the beginning of or sometime during last year briefly been able to go above this $1,900 per ounce, and since then it has come back a little bit. But at least compared to where it was 10 years ago, or a little bit more than 10 years ago, it has risen by some 25%. But in spite of that, the gold miners index is still some 50% below where it was back then. So gold miners have tremendously underperformed the gold price. Why? Because often in the past, gold companies didn't do a lot of intelligent things. They did a lot of stupid things. They acted normally in a pro-cyclical way. What I mean by that is when the gold price was high, they bought a competitor at a very high premium, or they increased their investments a lot. And then when the gold price then fell, then these takeovers or investments were not profitable anymore. So not a lot of discipline when it came to capital allocation. This time it's very different. Here you see the gold price in beige and the capex, capital expenditures of the top 50 miners in blue. And again, you see what I said before, normally the two went in the same direction, but in this recently you see gold price going up, but the capital expenditures of the gold companies didn't follow. So, and that now allows these companies at these kind of gold prices to generate a lot of free cash flow, and more and more they're using this free cash flow to reduce their debt, increase their dividends, buy back their shares, so to do something which is value creative for their shareholders, whereas in the past they tended more to destroy value. Now they're creating value. So how is my gold company portfolio invested? Again, I tend to look at gold companies as a cheap long-term option on the gold price, and again they're very profitable at this kind of gold prices. Even somewhat lower gold prices would not be a problem for them. And here also within that part, I try to find a good mix between offense and defense, which means that I have divided my gold investments between companies which are more, let's say, more risky, and companies which are less risky. The less risky companies, more defensive companies, is what are often called the royalty companies. These are companies that finance specific projects of a producer, and because of their financing, they get part of the production, but they're not exposed to any other risks. They're not exposed to rising energy prices or rising labor costs, etc. So you could say they're more like something like a private equity fund. And the producers obviously are the typical producers, the Newmans of this world, and there's this selectivity is very important. You need good management teams, a good track record for the management team. You also need for companies to have their resources, their reserves in countries which are geopolitically stable. So all my gold companies basically have their production, their reserves in North America. And I think in these times that's a big advantage. Then you need companies which have a good balance sheet, because if they have to issue more equity to raise capital, then you get diluted. So I want to avoid that. And here also the idea, a little bit like for the bonds, is to adopt a contrarian approach. When the gold price is weak, the gold company's stock price is even weaker, and that's maybe a good time to buy them. And when the gold price increases and the stock price of these companies increases, then maybe it's a good time to reduce a little bit the allocation towards gold. That's the way I proceed. Again, gold companies are volatile, so you have to be willing to accept the volatility of this segment. I'm willing to do that because I think it's worthwhile in the medium to long term. Currency allocation, not a lot to say about the currency allocation. I said before, Swiss franc and yen, again, also have their role to play in the construction of the portfolio, in this idea of a good mix between risk off, risk on. So they together represent something like 24%. I hedge part of the dollar exposure, not because I have a strong view on the dollar, but simply because I want to increase my euro exposure. In the end, the fund's base currency is the euro, but I don't have that many euro investments. My gold portion is not in euro, my bond portion is not in euro, and even within the equity portion, the eurozone is not that high. So to at least to be able to raise my euro exposure to something like 30%, because after all it's the base currency of the fund, I hedge part of the dollar exposure. So in the end, again, this is the asset allocation, which I said before. Equity 70%, around 70% equities, bonds are around 6%, gold around 13 to 14%, and some 10% in cash, which gives me some ammunition if we to find maybe new opportunities. But as I said in the beginning, I prefer to a certain degree this kind of asset allocation where I make more the distinction between risk on, risk off, because again, as I said in the beginning, I with my 70% equities, or even 83% equities, if you add the gold portion, I sometimes notice that in difficult times for the equity market, my fund loses less than a fund which might only have 30% equities, much more risky equities, and sometimes my fund might lose more than a fund which has 95% in equities, but even more defensive equities. So I think simply looking at the equity weighting of a fund and concluding that that fund is risky or not makes less and less sense. So this is right now the asset allocation. Maybe last word on performance and on this year. So this year until the end of September, you could say most of the equity classes contributed to the performance of the fund, the one exception being the gold companies, which until the end of September were negative. Since then, things have improved, and September, generally speaking, has been a difficult month for the fund because with the slight increase in interest rates, basically equities were weaker, bond markets were weaker, and gold, and especially gold companies, were weaker. So September was not by far the best month of the fund, but since October, things have improved again. The fund is now around 8.5% to 9% up year to date, and gold companies have recovered quite nicely. So from that point of view, the performance this year is okay. But one has to be aware, I would say the big risk for the construction of the fund would be a lasting rise in real interest rates, and because then obviously that would not be very good for stocks, it would not be very good for bonds, and it would not be very good for gold. So one has to be aware of that risk, one has to monitor that risk, but right now I still think that we are not in an environment which points to that happening, even if nominal interest rates were to rise slightly with much higher inflation. I think that there's right now there's a scenario of rising real interest rates is not what I would expect. But again, one has to remain humble and be willing maybe to monitor these things on a constant basis. But apart from that, I think the main message is a little bit this, what you see here, this mix between offense and defense, which I try to achieve. Gold companies, I've put them here in the middle. Long term, obviously, they're more on the risk of defense side, but from time to time, they sometimes take on more risk on characteristics. So that's why I put them in the middle. Quality, very, very important in all of my investments, whether it's equities, bonds, and gold companies. And again, this idea of finding this right mix between the two. So I'll end there and open it up for questions if you have any questions.
Thank you very much, Guy. At the moment, I do not see any questions in our chat system. If you have any questions, please feel free to ask them now so Guy can answer to them directly. Nevertheless, if you have questions coming later in the coming days, you can always send them to your sales representative. They will be happy to liaise with us so that we can give you a proper answer. I do not see any questions coming right now, so I think we can close the call now. I would like to thank you very much for attending this conference. Many thanks, Guy, for your presentation. I think it was very clear. And I wish you all a very good week. As a reminder, we will publish a summary of the call in the coming days. Thank you very much all, and have a nice day.
Thank you very much.